Okay, good morning. Welcome to the session. Things are looking very heavy right now. So the S&P, just look at my chart, top left, S&P breaking down below that low point from the 7th of August. Look at my DAX chart on the right here. Just testing, and we'll almost certainly see a break of the 27th of July low here. Equities, there you go, S&P extending lower now. You're getting a nice sort of inverse correlation with euro-dollar, which has been on the front foot. You've got dollar weakness, you've got equity weakness, you've got bond market strength, you've got generally commodity weakness. This is further fallout from the major news of the week, which is China devaluing their currency. So it's gone again today I should say. So the Chinese devaluation of their currency yesterday, 1.9% lower against the dollar. Today, another 1.6%. So we got the two biggest sell-offs in the Chinese yuan since in over a decade. Yesterday and today. So today's the second biggest sell-off in a decade. Yesterday's the biggest. So this is having a pretty broad-based effect across assets globally. It's hard to know where to start here. Let's just bring up the daily chart of the S&P, because this is a nice breakout here on the downside. This is looking pretty heavy, to say the least. I'm going to go to a daily chart because the next support level is here, which is the low point on the 27th of July. That's the price point the DAX has just taken out. This was also notable because it was the May low. Okay, so 2056, 2057. Key level here, the most important level of support on the downside isn't until we get down to 2032. This is the double bottom for March and April, and then actually also July as well. So definitely heavy here. Yesterday's session, the S&P lost 1%, and here we are today, 1% down already. This is having a broad-based effect across assets. I mentioned Apple yesterday. Apple down 5% yesterday off the back of China's move. Currency weakening. This will be a direct revenue negative for exporters who sell products in China. Of course, Apple becoming more and more dependent on the Chinese consumer. Also, you've got broad-based weakness across commodity markets. And this is as a result of the fact that commodities are sold in dollars, and now the yuan is cheaper against the dollar, making commodities more expensive. So you could argue maybe this means demand from China will be less because they can afford less. There was a Citigroup analyst who made a decent point on that, and that was that, yeah, sure, in theory that's right, but let's be honest, commodity prices are so cheap anyway that it's probably not going to have too much of an effect. But the short-term reaction is definitely broad-based sell-offs across commodity spaces. All the metals getting hit, copper, iron ore, nickel, you name it, all the metals down sharply. You've got the energy space. If I just bring my oil chart into play here, oil, big move to the downside throughout yesterday. I just want to show you I want to show you a weekly chart for crude oil, because this move over the last 6 weeks is just extraordinary. But the most important thing is this low we had back in March on the continuation chart at $42. The low point we had yesterday was at 42.69. So we're pretty much there now in terms of this very key technical support level. So that's something to bear in mind. If we do get weakness as we go through the session, we got oil inventory data today as well from the US. But just on a 1 hour chart, that move to the downside finished, bottomed out around 7 o'clock. We got a decent lift overnight, but then as China, the People's Bank of China set the latest fix on their currency exchange and fixed it 1.6% lower than yesterday, you had big moves across markets again. So big sell-off on oil. You had big downside on the S&P and equities generally at 2 a.m. last night off the back of this move. Just looking at euro-dollar here, which is climbing. So why is the dollar weak? And really, you've got to say, I was of this opinion anyway. Let me just adjust some of these lines. I was of this opinion anyway, as you know, but I think forget a September hike from the Fed. I think it's absolutely off the table, purely as a result of what China have done. If you're looking at the percentages, well, we talked about this last week in that after payrolls on Friday, the percentage chance of a rate hike in September went up. It went up from 48% up to 54%. Well, yesterday, you saw broad-based movement on bond yields dropping, and actually the percentage chance now is back down to 40%. So I think, I don't think the Fed were going to do it anyway, but I think this China move has made that September hike, I think, just an absolute non-starter. And we move towards the idea that it's going to be later in the year. And so this has helped to weaken the dollar. So you're getting dollar weakness here. If we just look on a daily chart, and against the euro, I guess, because we've had positive news on Greece, and this has also helped to support this market. And we've been moving higher over the last few days, and today certainly decent start. We're just testing the high point from the 31st of July. The most important technical level will be the 27th of July high, but we've broken this downward trend line over the last couple of sessions, so technically this is looking a little more positive, but 111.37 is a key level. So dollar weakness, US bond yields dropping as we price out a September hike. Equity markets weak, and that, generally I think, whilst there's valid reasons why China have done this, with regards to making their currency more of a market-driven exchange rate, a fully floating rate currency. Well, it's not that yet, but it will be in a few years' time. You could say this is an important milestone in the evolution and the opening up of Chinese markets, and it's an important move to try and get the IMF to support their application for the SDR, so making the Chinese currency a more global reserve currency, joining the dollar, the yen, the euro, the pound in the SDR. And this is, the IMF have been positive about this development in terms of the opening up of the Chinese exchange rate. So you could say it's for those reasons they've done it, and that's certainly valid. But as I said yesterday, I think that an important sort of side effect of this devaluation is more economic stimulus. And you could say that the yuan has appreciated in value quite considerably over the last sort of 18 months or so, mainly thanks to the dollar strength, of course. And so this has created a negative competitive or a competitive disadvantage for China, particularly in Asia and in the sort of the export world, and their exports have been suffering as a result. So you could say this is just the yuan playing catch up on what has been currency devaluation for most of the rest of the world. Now, you've seen big moves on Asian currencies. Pretty much all Asian currencies, well, perhaps apart from the yen, have been sharply lower off this development. So all the economies dependent on China, so the likes of Australia, New Zealand, Korea, Taiwan, and so on, all these currencies have seen more than 1% drops. But I guess to put this in perspective, these moves aren't that big. There was a good stat I read this morning. Brazil, the Brazilian real, has actually had 10 days this year where their currency has moved by a greater amount than what we've seen the yuan move on either of the last 2 days. So whilst this is absolutely dominating headlines, I opened my FT app this morning and I think literally like 6 of the first 10 articles were about China. So it's absolutely swamped the media space. But from an emerging market, not that China are an emerging market, but from an emerging market perspective, these currency swings actually aren't that dramatic. What we've seen is the first retaliation overnight, because this really does open up this idea that this is the global currency war being taken to a whole new level. So we've had the first retaliation last night. Vietnam have widened their trading band from 1% to 2% against the dollar. So this is and they said the reasons for this decision was entirely due to the decision made by the People's Bank of China yesterday. So you're starting to get a retaliation, and this might just be sort of exporting deflation across the Asian region, and we've got a real problem with deflation there anyway. So this, on the one hand, you could say it's just China opening up their markets, making them more market-driven, an important part of their evolution. But I think it stinks of a bit of panic at a government level, a panic about the economic deterioration and yet more stimulus effort to try and stabilize things. So I think you're generally seeing a bit of a panic across markets. So the S&P heavy, not quite there yet, but just about to test this 2056 level. So you've got energy and commodity stocks very weak, mining stocks very weak. You've also got exporters that depend on Chinese revenue very weak, and then you've got a broad-based risk-off anyway because it just exacerbates concerns about China's growth. Check the Bund here. I'm just going to move that to a daily chart because for the Bund this has been a decent move now. Moving up. This is the highest we've been since May, and you can see that the key level in May was 155.79. So we're about 30 ticks off that. That's a very key resistance level, something to look for. In terms of yields in Europe, Vas was telling me earlier the German 2-year, that's the Schatz, the 2-year yield is actually now at a record low. So lower than we were, earlier in the year. When the Bund got down, when the Bund was down at its low here back on the 10th of June, where it moved down to about a yield of 0.15%. I think it was on the low. I'm talking. What am I talking about? The high up here in April. High prices, low yield. So the mid-April high for price here was when the yield hit 0.15%. So the Schatz has a yield that's lower than it was back in mid-April when these markets kind of had this peak. So you've definitely got big fallout across markets. It's absolutely the dominant force across global assets and will continue to be so. So interesting stuff. I've got a chart here if you want to just see this move on the currency for China. How does this stack up in terms of the long-term trends? Well, this is the move we've seen, and we're kind of heading towards 6.5 yuan versus the dollar. And so you can see that this dramatic move here has taken us back to levels not seen since 2011. But you can see that this has been on the downside. So actually, just over the last few years, the yuan has been appreciating against the dollar. Okay, perhaps weakening again over the last 18 months, but you've got to understand that the dollar has gone through a huge strengthening cycle over the last 12 months. And this has led to the yuan being pegged to the dollar, appreciating quite dramatically against, relative to currencies, their trading partners in Asia. And this has really helped to generate this kind of weak economic outlook for China. Right, let's look at the calendar for the day. We've got some data from the UK. This is coming at 9:30. Let me bring the calendar into the screenshot here. So, first Italian trade balance at 9. We got then the employment report from the UK at 9:30. So we'll be looking at the claimant count, jobless claims. We've got average weekly earnings. So as you will know, this is important with regards to looking at wage growth, measuring wage growth. When might the Bank of England hike rates? We had a really dovish event last week with the Monetary Policy Committee passing an 8-1 vote. So only McCafferty was the single person voting for a hike. We thought it was going to be 7-2 or maybe even 6-3. But a dovish outcome last week from the Bank of England, and we'll see if this is expected to be kind of confirmed in that we're expecting the average weekly earnings, this is for June, mind, so bear that in mind, to have dropped from 3.2% down to 2.8%. We'll get the unemployment rate, that's expected to stay unchanged at 5.6%. So important labour market data at 9:30 from the UK. We then get industrial production data at 10 o'clock from Europe. We're expecting minus 0.1%, another negative print. Then we kind of move into the afternoon, and the kind of two big data points of the afternoon will be the 3 o'clock JOLTS job openings numbers, and then the Department of Energy crude oil data. We've had data overnight as well already from China, We've had their retail sales figures coming in and their industrial production data. Industrial production was worse than expected, plus 6% annualized growth. We had expected 6.6%. Retail sales were in line at 10.4% growth annualized. So again, mixed, but on the industrial production side, disappointing. So just adding to that weak data point, I mean, the big data of the week from China was that export number earlier in the week coming in at below -8%. And perhaps that certainly helped to trigger the decision-making from the People's Bank of China. But the Department of Energy numbers are important, of course. They're going to be coming, as usual, at 3:30. I'm just going to get a read on the API from last night. Just give me a second. So the inventory data from the API last night showed a drawdown, a decrease in crude inventories of 847,000 barrels. So a drawdown, but a smaller one than the week before, where we got 2.4 million. So we'll see what this brings. But of course, the price of oil looking very bearish still, despite that bounce we had on Monday. That's kind of just all gone, and it's looking very weak. I mean, the 42 handle in sight, and it's probably not going to take much to get us down there. But one thing that's counteracting that is this weakness in the dollar that we've got. So that's kind of just hindering the downside for commodities. But it's quite notable. We're getting dollar weakness plus generally commodity weakness simultaneously, as we are very fearful about China, and the People's Bank of China action has dramatically reduced the chance that the Fed will hike rates in September. So, should be a very interesting day ahead. I think we had risk off yesterday. I'd be surprised if we didn't get more risk off today. I mean, the DAX yesterday, the DAX dropped 2.85%. Today, we're already more than 2% down. So this is a big move, and the DAX and Germany, the most exposed economy to China, a lot of German exports going to China. So the DAX is leading the charge to the downside. I mean, if you look at your Eurostoxx charts, well, sure, that's heavily negative as well, but not as much. So yesterday we had 2.1% down, and today we've got actually the same, 2.1%. But the Eurostoxx have been testing that low point from the 27th of July. So Eurostoxx has not broken that 27th of July low, whereas the DAX briefly there went below it. So this is the 11,000 handle, of course, so this is important psychologically. All right, so let's see how we get on. We've got Italian numbers in 1.5 minutes, and then the UK Labour report at 9:30. Enjoy the session.